Welcome to the deep dive. Today, we are putting on the protective gear for a deep dive focused squarely on, well, how to navigate the very volatile world of cryptocurrency investment. This is not about hype. It's not about maximalism. It's really about survival. We've gone through a stack of sources. We're talking in institutional analysis, risk reports, pro-trading strategies, and our whole mission here is to just cut through all that market noise. We want to pull out the core practical knowledge you need for, disciplined due diligence and real portfolio management. Think of it as a shortcut to how the pros avoid the most common and most costly pitfalls.
And we absolutely have to start by just establishing the battlefield. Our sources make it so clear. Cryptocurrency is an exceptionally high-risk asset class. I mean, when you look at the raw data, its annualized volatility is around 55%.
55, wow.
Yeah, and to put that in perspective, that's roughly 4 times the volatility of the S&P 500 index.
4 times. That's staggering.
It really is. And this extreme volatility means massive drawdowns, steep declines, sometimes up to 70% over just 12 months, are common. They're expected. It's actually normal for this asset class.
Okay, so you have to go in expecting that.
You have to. So for anyone building a diversified portfolio, you have to get that even a tiny allocation in crypto can have this outsized impact on your total risk. That's why the professional analysis, it strongly suggests limiting your exposure to, say, a maximum of 2 to 4% in the most aggressive portfolios.
And for conservative ones?
Zero. Just zero exposure. If you don't anchor your allocation in that reality first, everything else is just gambling.
That makes the stakes crystal clear. Okay, let's unpack this and let's start where most new investors bleed value without even knowing it. The hidden costs.
The friction costs, yeah. And friction is the perfect word. It's this unavoidable drag on your performance. When you trade on traditional markets, transaction costs are pretty low. They're transparent. In crypto, though, especially when you're dealing with decentralized exchanges or moving assets on-chain...
Meaning directly on the blockchain itself?
Exactly. You run into 2 non-obvious costs that are just massive performance killers for anyone who trades a lot. These are gas fees and slippage.
Let's start with gas fees. They seem more straightforward, but they can be just as painful.
They really can. Gas fees are basically the transaction costs you pay to miners or validators to process your activity on a network like Ethereum. And you pay gas for every single thing. Swapping a token, transferring an asset, interacting with a smart contract, everything.
And the cost isn't fixed.
Not at all. Yeah. It's a bidding war for block space. So when the network gets busy, those fees just spike. You could be paying $5 one minute and then $50 or even $100 the next.
Okay, and that leads right into the really insidious one, slippage. When I buy a stock, I expect to pay the price I see on the screen. In crypto, that price is, it's often just a suggestion, right?
It's just a suggestion. That's a great way to put it. Slippage is that difference between the price you expected and the price you actually got. It happens because of 2 things. Intense volatility, sure, but more importantly, low liquidity, especially in smaller tokens.
So there just isn't enough for sale at that price.
Right. If you try to buy, say, $10,000 worth of some little-known altcoin, there probably isn't enough available right at your price. Your order has to fill across higher and higher price points, and your final cost gets worse and worse.
And the sources show that gap can be huge.
Oh, it can easily hit 1 to 3% per trade for small-cap assets. And the compounding effect is what's truly shocking. Our sources walk through this one example, and it's startling. Imagine you're managing a moderate $50,000 portfolio, and it's spread across 100 different altcoins.
Okay, 100 tokens.
Now, if you just tried a single full monthly rebalance of that portfolio, the friction costs are just crippling.
Walk us through the math on that one rebalance.
Okay, so assuming pretty modest gas fees and maybe 1.5% slippage, the cost would be about $2,250.
For one rebalance.
For one. That's about $1,500 lost just to gas fees for 100 transactions, plus another $750 lost to slippage. So you've just wiped out 4.5% of your entire portfolio in costs before the market has even moved an inch.
Wow. 4.5% just hit the rebalance button. So over a year of doing that monthly, that execution tax could eat up, over 20% of your starting capital?
Easily.
Why do people tolerate that? Are they just not aware of slippage, or is this just the price of admission for DeFi?
It's a bit of both. I think a lot of retail traders just see the asset price and they ignore the execution cost. especially slippage, which is kind of hidden. And for many of these altcoins, there just isn't a high liquidity option. So this drag, it creates an almost impossible hurdle. You have to get insane returns just to break even on your trading.
So we've identified the problem.
Yeah.
But the sources do point to an innovative solution for this, for people who want that diversification without the cost nightmare. Things like crypto index solutions. The TM Global 100 Index was mentioned.
This is a perfect example of structure solving a friction problem. These indexes, they give you exposure to dozens, sometimes 100 tokens, but they package it all into a single asset. The beauty is you get that broad diversification by doing one transaction, not 100.
So instead of 100 gas fees, I pay one.
Exactly. One transaction versus 100. That's a 99% reduction in gas fees alone. And when you factor in the reduced slippage from one big liquid trade versus 100 small illiquid ones, the annual savings could be over $13,000 on that $50,000 portfolio. It's a really elegant solution to a basic economic problem.
Okay, here's where it gets really interesting for anyone listening. How do we actually filter out the junk? How do we avoid the traps set by, pure speculation and outright scams? We need a foundational screening tool.
And the primary, I'd say, non-negotiable risk filter you have to apply is market capitalization. That's the total value, right? The current price times the total circulating supply.
And you highlight this because price alone is so misleading.
Terribly misleading. You might see a $100 token and think it's high value, but if only 100 of them exist, its market cap is tiny. On the other hand, a 10-cent token with billions in circulation could have a much higher market cap, and with that, more liquidity and stability.
That makes perfect sense. Yeah. So we're using market cap not as a filter for quality, but really for risk and liquidity. But I have to ask, isn't the dominance of something like Bitcoin or Ethereum just a first mover advantage? Shouldn't we look past the high market cap if a mid-cap project has, genuinely better tech?
That's a great question, a critical one. And the market cap filter is, indeed, all about risk. And here's why. We can break assets into 3 risk profiles. The least risky are the large cap assets. We're talking anything over $10 billion. Your Bitcoins, your Ethereums, they have huge network effects, massive liquidity.
Got it.
Next up are the mid caps. That's between 1 and 10 billion. This is kind of the sweet spot for a lot of innovative projects, but they come with medium volatility, and you have to do really deep due diligence. You can find winners here, but you have to work for it.
And then we enter the danger zone.
The real danger zone, yeah, the small cap category. Anything under $1 billion, these are defined by high to, extreme volatility, critically low liquidity, and they are just dominated by pure speculation. This is where 90% of the scams and the short-term pumps live because it takes so little money to move the price.
And that low liquidity makes them perfect targets for the classic pump and dump scheme.
Absolutely. It's a deliberate wealth transfer. The mechanics are simple, but they're so effective. Scammers find these little-known, low-liquidity coins. They quietly buy up a bunch at cheap prices, and then they just aggressively promote them everywhere. Social media, forums, Telegram. They're banking entirely on FOMO, the fear of missing out, to pull in retail investors, which creates this huge spike in buying pressure.
And the organizers are just watching the chart, waiting for that peak.
They are. And once the price is high enough, they dump all their coins at once. They realize massive profits, and the price just collapses. We saw this in the sources with the Froggy coin scam. The devs built up all this hype, and as soon as enough outside money came in, they just drained the liquidity pool. It's called a rug pull.
And investors are left holding worthless assets.
Worthless, and often they can't even sell them because there's no mechanism left to trade.
So the immediate takeaway for you listening has to be twofold. First, treat anything under that $1 billion threshold as pure speculation. Second, be really wary of those massive, crazy price jumps.
Exactly. If you see some token jump 80 or 100% in a day or two, and there's no verifiable major fundamental news like a huge partnership or a regulatory green light, it is almost certainly an artificial pump. That's your signal to stay away.
That brings us right to fundamental evaluation. We need to look past the hype. We need to evaluate the internal mechanics of a project because, as the analysts say, hype dies fast, fundamentals last.
That phrase just nails it. It's the difference between something fleeting and something built to last. You have to contrast projects driven by pure hype, your meme coins like PEPE or eShibe, where the momentum is just community jokes or a celebrity tweet, with projects driven by genuine utility. Utility projects are sustained by what they do. They solve a real problem. Ethereum powers DeFi. Chainlink is the backbone for Oracle networks, connecting smart contracts to real-world data. If you take away the utility from those projects, they stop working. If you take the memes away from a meme coin, well, nothing really changes.
And the key to spotting that difference between a real project and just a marketing scheme is to decode its tokenomics. This is basically the project's entire economic blueprint. It defines how the token is issued, distributed, how it accrues value.
And if that project's white paper reads like some glossy brochure promising you'll get rich quick, just avoid it. You're looking for documents that are technical, well-cited, focused on mechanism design. The sources draw a really sharp contrast here. Look at the technical papers for Chainlink versus a project like Peepacoin, which, to its credit, openly says it has no intrinsic value. You need that honesty.
Okay, so a deep dive into tokenomics reveals 3 absolutely crucial areas for long-term value. Let's start with the supply model.
This is fundamental. You need to know if the asset creates verifiable scarcity. So you contrast a fixed supply model, like Bitcoin's 21 million coin cap, which guarantees no new inflation ever with other models. You see elastic supply models where supply adjusts to demand, but that risks dilution if inflation gets out of control.
And then there are the deflationary ones.
Yes. A lot of modern projects use a deflationary mechanism, like burning a portion of transaction fees to permanently remove tokens from circulation. You can think of it like a corporate stock buyback, but they're using transaction fees instead of cash to fight issuance. You have to do the math. Is the burn rate higher than the new token issuance rate? If it's not, the token is still inflationary. That hurts long-term holders.
Okay, second point, vesting cycles. These are so crucial because they're the best predictor of future selling pressure from insiders.
Exactly. This is all about trust. You're looking for 2 things. First is the cliff period. That's the initial time, maybe 6 to 12 months, where the teams and early investors' tokens are totally locked. Nobody can sell.
Got it.
After that cliff, the tokens enter the linear release phase. They unlock evenly over a few years. But a large, sudden unlock like 50% of the team's tokens unlocking right after the cliff, that is a giant red flag. It means guaranteed selling pressure is about to hit the market, and it'll crush any organic growth. You want smooth, long-term release schedules. It signals commitment.
And the third area is how the token itself captures value from the ecosystem's success.
Right, value capture. You have to ask, how does the project's success flow back to me, the token holder? If the blockchain is doing great, but all the profits go to the founding company, why should I hold the token?
So what should you look for?
Look for mechanisms like fee capture, where a part of transaction fees are shared with stakers, with the people who help secure the network. Also look for governance rights, so the token gives you voting power over the protocol's future. If the token is just a currency used inside the system without those rights, its long-term appeal is, well, it's pretty limited.
This whole discussion really shifts us away from emotion and toward logical, systematic management. So let's move to the practical strategies that inject discipline and minimize those emotional pitfalls.
Yeah, we're moving from what to buy to how much to buy. This is why analysts call position sizing mastery the glue that holds together a sound trading system. It's all about surviving the volatility. The core rule here is, it's non-negotiable. It's based on pure survival math. Never risk more than 1 to 2% of your total available capital on any single trade.
1 to 2%. That seems incredibly conservative in a market that basically encourages going all in.
It sounds conservative, but it is the secret to longevity. The process fundamentally flips the script. You don't start by dreaming about how much you could gain. You start by defining your risk. You have to define your stop loss order. That's your specific exit price, where the trade just closes automatically first. Then and only then do you calculate your position size.
Let's walk through the calculation to make it really concrete. Say I have a $25,000 trading account and I'm sticking to that 2% risk rule.
Okay, so your max risk on that trade is $500, period. Now, let's say you look at a chart and decide that if the price falls $30 from where it is now, your thesis is broken. So you set your stop loss $30 away. You take your $500 max risk and you divide it by that $30 risk per share.
And that limits my position size to 16 shares, which is a $3,600 position.
Correct. And that mathematical control is everything. By doing this, even if the trade goes completely wrong and hits your stop, you only lose that small, predetermined $500. This discipline gives you 50 to 100 chances to be wrong before your capital is seriously damaged. It stops you from thinking about huge gains and forces you to stare risk right in the face before you commit a single dollar.
That completely changes the emotional contract you have with the market. It turns trading into more of a strategic game instead of just a series of hopeful bets.
Exactly. And the second cornerstone of this, which goes hand in hand with position sizing, is dollar cost averaging, or DCA. This just means you contribute a set amount of money each period, say $500 a month, and you completely ignore the asset's price.
The advantage there seems almost purely psychological.
It is. It drastically reduces the negative effects of investor psychology. When the market is booming, people get greedy, they buy too much at the top. When it crashes, they panic and sell at the bottom. DCA removes that need to time the market. It forces you to just focus on consistent, long-term contributions. You end up buying more shares when prices are low and fewer when they're high, which lowers your average cost over time.
And in a market like crypto, where opportunities seem to come and go so fast, sitting on the sidelines waiting for the perfect entry can be a huge opportunity cost in itself.
Yeah.
DCA solves that hesitation.
It does. It gives you a structured way to participate consistently, and it smooths out those extreme price swings. The obvious downside, of course, is it can't protect you if the market just keeps declining for a very long time. But in an asset class with such massive cyclical volatility, it's a true survival mechanism.
So when you boil it all down, what's the core lesson here?
The core lesson is powerful. Crypto is new technology, sure, but it is not an environment where the fundamental laws of economics or risk management are suspended. Disciplined strategies like DCA and rigid position sizing are absolutely essential for survival.
So we've armed you with the filters for quality and survival. Remember to consistently filter assets by market cap, prioritize true utility over that fleeting hype, and really understand the internal structure through tokenomics, especially looking for verifiable scarcity and healthy long-term vesting cycles. But I want to leave you with this final provocative thought to mull over. Considering the exceptional volatility we talked about, the potential for those gut-wrenching 70% drawdowns in a year, and the rising correlation between crypto and other risky assets like speculative stocks, how may consistently implementing dollar cost averaging and strict position sizing fundamentally change your emotional relationship with the market? What stands out to you? That's it for this deep dive. We'll see you next time.